Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Katherine Frattarola. She's executive vice president at Hub International to discuss the evolving insurance landscape due to natural disasters and regulation and what it means for high net worth individuals. Katherine, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me this afternoon, Jill.
It really is interesting how the insurance landscape is encountering unprecedented change. What are the factors that impacts it?
Well, yes, there are major headwinds facing us today, particularly in the high net worth and ultra high net worth market, which is the market demographic that Hub Private Client serves. First and foremost, our clients move to places where the land burns, the earth shakes, and the wind blows. So they're moving to barrier islands off the coast of Florida and Georgia. And as we all know, barrier islands are nature's response to protect the mainland from wind and storm surge. They're moving to mountaintops surrounded by brush and forest and perches of cliffs overlooking the Pacific Ocean. And on top of it, to exacerbate the situation, they're oftentimes choosing aesthetic sort of building techniques versus things that are more practical, like wood roofs, or they're deciding to keep their lead glass windows in their 1930s colonial as they're redesigning and renovating their home. And so some might argue that this isn't new, and that's correct, but it's been exacerbated because what we've seen over the last handful of years is the frequency and intensity of catastrophes has increased. So if we look at hurricanes, just to put a finer point on it, from let's say 2007 to 2015, we had exactly 0 Category 3 or higher storms hit the United States. But if we looked at 2016 to present, that number goes dramatically higher to 7. Right? So if I'm a Florida homeowner, let's say in Naples, which is the epicenter of Hurricane Ian at the fall of last year, and I had a pencil in my hand and I walked from one coast to the other, I would at no point be higher than 12 feet above sea level. So you combine that with concentration risk of lots of high net worth and ultra high net worth homeowners living in the same places against a backdrop over the last couple of years of COVID. Now, COVID thankfully is in the background for many people around the United States and the world, but it's certainly in the foreground for the insurance industry. We're still seeing the reverberating effects of labor shortages, of supply chain issues, of other inflationary events that are putting pressure on the price of goods and services. And so when our clients and homeowners go through claim situations, that's a profitability issue for the carriers who are now paying more to replace those homes. And you mentioned regulation, and that would be the last piece of the puzzle. Much of the regulation was enacted decades ago in the spirit of protecting homeowners from escalating rates year after year. The unfortunate part is we're now in this period of rate inadequacy in many markets, whereby the rate that carriers are allowed to charge homeowners is inconsistent with the risk that they're undertaking as a result of all of those factors that I laid out. So again, it's causing an issue with profitability, which means they're either operating at a loss or making the unenviable decision of having to either retrench or exit a market completely.
Well, that's what we're seeing happen in California. There's
Absolutely.
a number of major carriers that are just no longer underwriting new policies. What happens in that circumstance? Can you just not get a house or live there, or are there private ways to go? And what happens?
Well, there's lots of different options. I mean, first it comes down to working with a risk advisor who's really attuned to the changing market conditions and who works for a firm that has preferential relationships with top high net worth carriers. The second is, there are some creative solutions, inclusive of turning to an E&S or an excess and surplus market, which is a little bit different than the traditional admitted markets that most homeowners are used to today. It allows carriers to take a little bit of risk but charge a greater price. The third is many are considering whether to self-insure, and for some people, particularly those who have means and don't have a mortgage on their home, it is a viable option, but it's not one that at Hub Private Client we recommend, because in periods of major catastrophe and major claims events, there are scarce resources. And so when you have the leverage of a well-disciplined carrier and a broker behind you, you're able to get back on your feet much more quickly.
What is self-insurance? I didn't even realize you could do that on a home.
You can. You can self-insure if you have no mortgage and you have the means and the risk tolerance to be able to do it, which basically means that if you live in a $5 or $10 million home and there's a wildfire that winds up ravaging your neighborhood and you lose your home, you don't need to actually have insurance coverage in that situation. And people are turning to self-insurance more and more because they don't want to pay either the outsized costs in the E&S market or just because they can't find insurance, period.
Do you think regulation is going to evolve? I mean, to your point earlier, where these 100-year storms are happening every 10 years, and the 10-year storms are happening we live through Sandy here in New York and New Jersey, so we're very well aware of the extensive damage that it caused. I mean, even in areas like Long Beach Island in New Jersey, they're just kind of finishing up all that work. I mean, even our subways, they've just been renovated in certain areas. It is quite devastating.
Absolutely. Listen, I think change is happening, but it's happening not as quickly as I think all of us in the industry would hope. I think seeing some of the major direct writers, including among the largest in the world, start to exit or pull back from major markets will create, hopefully, the right type of organic pressure to cause state legislatures as well as departments of insurance to reevaluate those regulations.
All right, we appreciate the insight, Katherine. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.